Donny, Nick, thanks for joining me on the show.
Great to be here, Owen. Thanks for having us.
Yeah, good to see you.
Well, I should be saying thanks for having me in your office here in Sydney. It's great to record in person. We're going to talk about the Global Fund. We're going to talk about the ETF that launched recently. We're going to talk about companies, portfolio construction, so much more. Probably the place I wanted to start was just haphazardly. I was just Googling you guys and coming up with some, trying to find some bios that I would read out at the start and blend them together with what we talk about today. But Donny, on one of the pages of one of the bios that I saw of yours, and I don't know if you put this there or if this is something that you think about quite often, but I think it speaks to the conversation today, which is, and this is the quote that was on the top of the bio page, that 4% of stocks contributed 100% of the stock market's gain since 1926. Invest accordingly, end quote. And I thought this is probably a good spot for us, but for all of us to riff on, but maybe starting with you, Donny, why would that be at the top of that page?
Yeah, sure. I guess fundamentally we are active managers, and what does that mean? We think that we can identify higher quality businesses that can compound at greater rates over time. So the base rate for most people is to invest in an index, and not all businesses are created equal, and the work of Eric Bessenber and others sort of proves out that it's a small number of companies that create the majority of returns in the indexes. Even if you look at the S&P 500 last year, quite good returns, but 72% of the companies in the S&P 500 actually underperformed the index return. And, we just think that spending the time and effort to identify the outstanding businesses can pay off and create some very good returns over time.
Nick, is there anything you would add?
Look, I just think, that's a core part of what shapes how we think about, picking stocks and what we're trying to do here in terms of, few businesses are great and most are not. But there really is two parts to it. If you're really talking about having a long-term time horizon, obviously it's identifying those good businesses, but then the next question is not being shaken out along the way. Yeah. I think one of my favorite quotes is investing is pretty simple, but not easy. And what that really comes back to is that, the market is always trying to give you a reason to sell. And, what you really need to have is the right mindset and process there that you can really lean on, when the proverbial hits the fan. Otherwise, you get into bad situations where you get shaken out at the worst time.
I feel like the two numbers that you threw out there, Donny, kind of speak to that as well, right? If you think about the 4%, and it varies by markets according to Professor Bessenbinder's work, but it varies by market. And interestingly, like if we say, was it say 2/3 last year or 3/4 not doing as well as the index, I feel like the longer you stretch that time horizon, the sharper and sharper that number would become. I haven't seen the data for myself, but to your point, Nick, about holding, I feel like you've got to find them to that 4%, but then you've got to hold them and let them kind of prove themselves again and again and again. And you guys seem to have done that through time. Like we were talking off air about different companies in the small companies portfolio, but then also on the global side, we talked about companies like MercadoLibre, which we'll bring up in a moment. But those types of businesses have won, but they keep winning. And that's really unique, I think, as well. Yeah, I'll just throw that out there.
Yeah, absolutely. And that's really where the power of compounding comes in, right? Is if you can identify those businesses, that's one thing. And then if you can hold them, continue to own them, let time do its work in terms of the compounding, that's where the real outsized returns are generated.
We've spoken before, Donny, so there's a question I'll ask you, Nick, about this, which is, I believe you guys refer to them internally as strategic advantages, if I'm not mistaken. But there are three which we're going to talk about today, one being intellectual property or IP, network effects, and loyalty. I want to talk about this, Nick, from the highest level perspective. So imagine you've got a new investor that walks through the Lakehouse door and they're just like, well, tell me how you invest. Tell me what you think. How do you frame that conversation, like thinking about these three things?
Yeah, sure. Look, I think taking a step back, and the real starting point here is our philosophy. And that really guides everything we do day to day. It's really the center of everything, and that is, we are long-term, high-conviction investors seeking asymmetric outcomes. So looking for those situations where we feel we have multiple ways to win and few ways to lose. I think when it comes to our strategy, what I would say is, and I think this is something that differentiates us to a lot of other managers out there, is that we have a very narrow focus. And this kind of bleeds on from exactly what we were talking about in the previous question. But, that's built around the belief that, few businesses are great, most are not. And as such, we try to be very particular and deliberate about the types of businesses we will own, but also the ones we won't own. So we will typically avoid, businesses operating in industries that are notoriously cyclical, capital intensive or hyper competitive. So you can think about auto manufacturers or real estate, for example. In our view, the majority of businesses in those industries just aren't that attractive for long-term investors. That is, their destinies tend to be impacted by, a number of factors that are beyond their control. And as a whole, they tend to be a bit more susceptible to, competitive threats, and, the returns just aren't really there for us. So instead, what we are seeking is really companies with two things. One, the strategic advantages you just mentioned. So that is extremely loyal customers, network effects, and unique and enduring IP. And then two, long-term industry tailwinds that are secular in nature. So whether it's the shift to e-commerce, cloud computing, or digital advertising, for example. So, in our view, those two factors, really drive the majority of long-term durable growth and shareholder value over time. So that is what we're really focused on. And I think, we're obviously a small team based here in Sydney. A big question we get a lot is around the size of the universe for global. And it is big. There's 3,000 to 4,000 companies out there. But the reality is, when you apply that lens over the top of really looking for those strategic advantages and, secular growth prospects, that universe whittles down pretty quickly, and you kind of come somewhere to about 300 or 400 businesses that are kind of within our investable universe.
I always love that when I think about what Lakehouse does, those three lenses that you look at these businesses through, rather than the traditional, screen-based toolkit that a lot of investors use, which is like sectors, geography, size. It's really starting with a pure form of what is a good business. Like if you think about any business down the street or, at the shopping center, it's the businesses that have a lot of customer loyalty, that have brands that you're really engaged with, or businesses that you shop with online being so much more convenient than some clunky service in person. I feel like it's a more pure way to approach what you are trying to find. And obviously, by its very nature, then it excludes all the things that you don't want. I should also mention that you guys have got a pretty remarkable track record across both strategies that you run. And so I think that's telling of this already, right? Because it showcases it in the Australian market, but also in the global market, which is really, really impressive. Donny, my question to you is, so when we think about other forms of what most value investors think of as like the competitive advantages, there are other things like low cost producer, efficient scale. Why did it end up with intellectual property, network effects, and loyalty, and not all those other ones?
Yeah, look, I think it's important to have focus, and that's really what we're talking about in terms of trying to identify those businesses. So you could expand that field further, but these were the ones that we thought were most powerful and created the most value over the investment horizon that we're looking at.
Mm-hmm. That makes sense. Yeah, it's always, I think, a bit of give and take here, because when you make a active decision, right, you're not just buying something, but you're also foregoing something else. And so that focus is really important. I want to dive into some companies which will illustrate the process in more detail, because I think it would be remiss of me not to go further into these. And Nick, given that you lead the global strategy, let's talk about that. And I'll, like Donny and I'll maybe chime in with hopefully some interesting insights as you go through, and maybe some follow-ups. But I would love to go through each of those buckets. So we've got networks, loyalty, IP. Take them in whatever order you want. demonstrate how the process unfolds, or at least tell the narrative of like a story that sits in one of these. And then that way we'll be able to kind of follow up and really tease out some of those finer points that you and the team, I guess, are working on each and every day.
Yeah, sure. I think a good starting point here is probably around networks. So two of our largest holdings are a pretty good example of what we're looking for here. And I'll kind of give you a bit of a snapshot over the top, and then you can dial in any questions that you might have. But that is the businesses I'm referring to are MercadoLibre and Amazon. So many similarities they have, but also quite a few differences. So Amazon and MercadoLibre both have, e-commerce businesses at their core. But in terms of geography, Amazon is obviously primarily focused on North America, has some other business outside in various other developed markets, whereas MercadoLibre is primarily focused on LATAM. But really 90% plus of that business is Brazil, Mexico, and Argentina. Beyond that, Amazon obviously has AWS, which is a leading cloud infrastructure provider, and MercadoLibre also has a pretty meaningful fintech business as well. I think for the purpose of this story and why we're kind of attracted to these types of businesses, because they're quite similar in many ways, I'll probably focus more on MercadoLibre, or Melli, as it's known for short. I think most people have a pretty good grasp on the Amazon story.
Yep.
But look, Melli was a business that was founded in 1999 by Marcos Galperin, and he still is the CEO today. Look, they've been incredibly successful in terms of having really have a track record that few businesses can match. So they're in 18 markets now. Like I said, though, up front, the primary markets are Brazil, Mexico, and Argentina. And last year they did just a little bit over $20 billion in revenue. Growth has been incredibly healthy. And I think to give you a bit of context around that, over just the last 5 years alone, the business has roughly 9x'd their revenue base. Wow. So pretty impressive by anyone's standard. Yeah. And, if someone was to ask me, well, what is the real reason they have been able to do that? I think in my mind, it comes down to, one key thing they've been good at, and that is, developing, aside from just having the core e-commerce marketplace business, they've done an exceptional job of developing, a number of other ancillary businesses around the edges. So payments, shipping, and advertising over time. And, not only does that expand their addressable market meaningfully, but it also goes a long way in terms of making the platform much more sticky to consumers and merchants. So obviously, multiple touch points, multiple products, you're getting to a point where that consumer habit is really built, and that merchant lock-in. I guess bring it back to the Lakehouse lens and the higher level pitch in terms of why we think it's special. It pretty much ticks all our boxes. So we're pretty clear in terms of what we're looking for out there, but you have a incredibly dominant founder-led business, consistently gaining share of a growing market. They have some very strong self-reinforcing network dynamics at play. And then importantly, given how successful they've been to date, I think this is important. We still think there's a long runway from here. And I say that because, e-commerce is relatively underpenetrated in the region. It's about 12 to 13% of retail sales, which is quite low if you look elsewhere around the world. And there's also a material percent of the population there that are still unbanked, particularly in areas like Mexico. So they still have a huge opportunity in front of them. And as the dominant player, we think they're in a great place to execute on that.
It's interesting because they've also got it's the Pago business, which is like
Mercado Pago, yep.
Yeah, Pago. Is that how you pronounce it? Yeah.
You could, yes. People like to liken it to a PayPal. So it's about 60% e-commerce, 40% fintech today. People kind of say it's like the PayPal of Latin America, but it is actually much more than that. So they do everything from payment processing, and that's on platform and off platform. But then they also provide loans, whether it's consumers, merchants, but then also everything from investment accounts. And this has really been something they've done really well over time, like I was saying, sort of stacking these businesses. And they're pretty shameless in terms of copying things that have worked well in other markets, whether it be Amazon with the logistics or looking at Ant Financial in China and copying, the fintech and the investment products. That's kind of been a pretty big theme over time for them.
It's interesting, because you say it's like stacking, but I can't remember, I lost the phrase that you just mentioned about the network effects kind of plugging into each other. So like if someone's using that or a merchant's using that to sell their goods, but then that like is just feeding in straight into more users on the e-commerce platform more broadly. And it's just this kind of flywheel on top of a flywheel, so to speak. Like each of them are just kind of harvesting more consumers. Maybe I'll ask one follow-up question here on the networks is like, how do you identify that that's happening? Like, is it just like raw number of users? Is it speaking to management? Is it trying to get a pulse on consumers? How do you find that Melly in the first place? Like, are there telltale signs?
I think in terms of trying to find a business like this and how we came across it, that was very much linked to watching Amazon, basically. So it's a business we understand. We understand the core marketplace and the network dynamics there. Like really when you have that platform business, obviously more users come to the platform, increases the value of that platform for users, and in turn, basically brings more users to that platform. And once you reach critical mass, these dynamics really reinforce the dominant player and the dominant network there. And that's what makes them so difficult to disrupt and worth so much. So we'd seen that play out with Amazon, and we were basically looking at other markets around the world where perhaps it was earlier in terms of penetration. And that's actually, to be honest, a pretty common way that we find a few different ideas in the global fund. Everyone, I'm sure all our listeners would be familiar with REA Group here. It's been one of the best performers on the ASX. Everyone knows the property portal, how good it is, how valuable it is. But we also own Hemnet, which is more or less the REA of Sweden. So it's the dominant property portal there. But we would argue even a few steps better. So they actually don't really have a second player. And they're also much earlier in monetizing that platform. So that's kind of a similar situation where we've seen a business model that we like, play out in another market much earlier in another market around the world.
Yeah, because that was one of the companies I think it was the most recent letter that I just had absolutely no idea what that did. And I was hoping you'd bring it up. That makes a lot of sense. Okay, cool. The next bucket is loyalty, which, I'm a pretty loyal Amazon user, to be honest. You don't have MercadoLibre here as far as I know, but I'm sure I'd love to try it. But I imagine it's one of these things where you get a lot of delight and people and consumers or businesses, if it's B2B, are just kind of sticking to that brand or that service. I know there are a couple of companies that cross the different strategic advantages. So feel free to chuck whatever you want in this bucket. But what are you looking for when you think about loyalty?
Yeah, I think one thing I'd just quickly say up front to your point there is, it's important to kind of break out that, one business can have multiple strategic advantages. There generally is one primary one. So you are very right. On something like an Amazon or a MercadoLibre, we very much could have talked to the loyalty dynamics at play around Prime and how that's basically the most successful consumer subscription business in the world. If you actually look at the retention metrics there, they've got more or less 2/3 of US adults as Prime members. And once you've been on there for 2 years, the retention rate is in the high 90s, which is, like something you never see in a consumer business. So there are those loyalty dynamics. But I think, the real core driver is those network dynamics. Speaking to loyalty specifically, I think a good business there to really hash out is ServiceNow. People probably aren't too familiar with that company, given it is a B2B software company. So it's a US software company that provides, its original dominance was in ITSM, which is like IT service management. So they provide a software solution where businesses can manage their IT services. So the most basic example there, and this is actually how ServiceNow started, is like a ticketing example. So you work for a big corporate, your laptop goes down, and you go, okay, someone needs to fix this or replace it. So you go there, lodge a ticket, and that kicks off, the whole support process and gets everything fixed. Like that original ticketing platform was actually ServiceNow, and that's how it started. Since then, it's become a much more comprehensive platform, of course, not only within IT, but in similar fashion, kind of to what I was talking about with Melly. One thing they've done is, had that first mover advantage and also that very sticky installed base to, automate a much wider variety of corporate workflows. So they've gone into customer service, HR, security, and those segments now are actually half of the business in their own right. So again, really expanding that addressable market that they have in front of them and improving the stickiness and the retention metrics of the platform, given that most customers now are even more deeply embedded in terms of using multiple solutions.
I saw some statistic, I can't remember off the top of my head, of how many other big like Fortune 500 companies use ServiceNow, because it was actually in anticipation for this. We hadn't spoken about it this ever in the 7 years of Rask, this business ever, which I'm like, it wasn't until I knew this conversation was coming up and then I jumped into the letters and I saw this business. And I think the phrase that you used was something like one of the highest quality SaaS businesses or business to business SaaS companies in the world. And I was like, how have I never heard of this thing? And the more I research it, the more I see like, wow, it's really impressive. Like all of those metrics. When you think about loyalty, and in particular, I imagine SaaS kind of makes this easier for you, but are you looking at those standard metrics like average retention, dollar-based net retention, recurring revenue, those types of things? Those are the things that kind of give you a hint that something might be there?
Yeah, for sure. For subscription businesses, definitely. Looking at retention rates is like the number one objective thing you can pull apart, right? Both, like you were saying, gross and net. So gross being just how many of your customer dollars are still there the next year, and net being including expansion from those existing customers. But you are right on ServiceNow that we do think it's, more or less the gold standard in terms of global enterprise software companies. We think it's got probably one of the most, valuable and stickiest customer bases out there. So they have about 85% of the Fortune 500 on the platform.
That's the one, yeah.
70% of all their incremental growth actually comes from existing customers. And then, retention there is about 98%. So people are more or less, they're not turning off their service now unless they're getting acquired and a new parent company says, hey, we're on this system. Doesn't happen that much, or they're going out of business, that type of thing. So incredibly sticky. And, those retention rates are not just best in class, but remarkably consistent. And that's really speaking to the mission critical nature of the platform and the differentiated offering they have.
I would encourage anyone listening to this or watching it, if you want to learn more, go and jump on the Lakehouse website and look at the letters. Some of the numbers that this company has put up, because it's not that old. This is a business that's not like, been around for 50 years, but it employs tens of thousands of people, and that's kind of just sprung up. And it's a classic like SaaS story at scale globally. It's incredible, which is wonderful. And it's now starting to get included in the major indices because it's finally, investors have recognized, but it's only now happening when a lot of that, like, it's obviously got more growth ahead, but obviously there's been a lot of growth already if you just look at the business through different lenses. So the next one, Nick, is IP. And I know, once again, I know a few businesses bridge this and they probably harvest it and they probably nurture it in that growth phase. So intellectual property, when I think of that, I think of like Disney or like a brand that's, I see on my TV every day, the advertising billboards, those types of things. When you think about IP, what are you thinking about?
Yeah, sure. So at the fundamental level, what we're really looking for is, intangible assets that aren't on the balance sheet but provide pricing power. And you're right, consumer brands is the most obvious one, and that's what most people are familiar with. We do look at that. But beyond that, you could have patents or even a unique corporate culture. Or something like that, basically something you think that gives them that edge. But, I think for IP, obviously various businesses we have certain dynamics of it, but in terms of owning ones where that's really the primary driver, like a Disney, for example, or an LVMH is something that obviously everyone can relate to as well. And that's a business that we have owned. We actually sold that, the majority about 18 months ago, and then our final stake more recently, and I can kind of go into that.
Sure.
But really, the key thing with a brand is, well, the question you are trying to ask is, if anyone tells you whether it's a smartphone maker luxury car maker, luxury goods, or whatever, Disney. The question is, can that business have consistent pricing power above inflation for an extended period of time? And that's why, we probably do struggle with something like a Disney. It is a bit more capital intensive as well, but a business like an LVMH or an Hermes, incredibly attractive to us. We've never had the chance to own Hermes purely on valuation grounds, but if you think about, an LVMH, for example, and what makes that kind of special to us, I'm assuming that most people are familiar with the business, but, they've got about 75, very iconic sort of heritage brands, and the majority of those brands have, greater than a 100-year operating history. So, not only do they, command that customer mindshare, but if you think about someone trying to really disrupt them or rip them off, it's very hard to do just because of the, the mindshare that has been built up over 100 years. I'm sure you could go out and design your own.
No one would want it.
Your new Birkin and see what you could charge for it. And you'll probably find out pretty quickly the value of like the Hermes bag or the Hermes brand, I should say. But yeah, they're really the dynamics in the luxury segment that we like. And also they have, I would say, probably a bit of better tailwinds than many of the other areas. But overall, I think we have found it a little more difficult recently to find names purely in that category. Like you could look at some of the medtech healthcare names as well. Obviously, there's a few recession fears out there at the moment. People get a bit spooked. And I think when you have that, a lot of people do tend to just hide in these, what they deem to be very predictable, durable businesses. And, the valuations on some of them, as MS is a great business, but if you've got to pay 50 times or whatever, next year's earnings, it's a bit of a difficult proposition. So
why did you sell LVMH?
Look, so there was a few little things that fed in there, but the big one really came back to valuation. So, we talk about being long-term a lot, and we certainly have that bias. But, I think obviously having that, you need to have a pretty clear sell discipline. And for us, there's really 4 reasons that we will sell. That is whether, a valuation stretches to the point that we deem, we can no longer hold it. A thesis breaks, or we're just trimming for risk management purposes because it's grown too large, or simply we think we have better opportunities. So in the case of LVMH, this wasn't so much just specific to them, but luxury in general had a huge boom out of the pandemic. And on top of that, you had price increases that were put through across the board for all this, whether it were Hermes or whoever it was, talking in the vicinity of, for some brands, 50, 60, 70% over the course of 3-4 years. So we were very much of the opinion that, whilst it's a good business, there was definitely going to be a digestion period for, while you kind of normalized off that boom and everyone digested those pricing increases. And on top of that, the valuation was very punchy. So, our internal modeling was probably coming back to, I think it was a single digit or high single digit IRR, which is, getting very much on the low side. And so we just deemed we had better opportunities elsewhere. But that said, what happens to a business like that? We don't think there's anything fundamentally broken about it. So for us, that goes onto our bench, which is, call it 10 or 12 names that we've either owned before, we've done our full work on. We would love to own the businesses, but there's something stopping us. And most of the time it is valuation. It's just about being patient and waiting for that opportunity to come around again.
Is that something that's applied across the business? Like that kind of, is there a shared discipline across whether you're looking at Aussie companies, global companies? Like do you, as the team or as a senior leadership team, do you have like a framework that you follow to constantly stress test positions? Is that the way it works?
Yeah, so we've got a portfolio scorecard system that we run. It's got 8 factors for global, 9 for smalls. We add in liquidity for smalls. It is a really important factor to consider on the small company's portfolio. But really you're looking at, and there's a mix of quantitative and qualitative elements to that. So the more quantitative side of things are, revenue growth, profitability of the business, what shape the balance sheet's in. And then on the more qualitative side, it's reinvestment runway, management quality, like leadership quality and their capital allocation skills and track record. And really what we do there is on a quarterly basis, we try to quantify as much of it as we can, and it's very documented and consistent across the team. So we've got a scoring from 1 to 5 for each of the categories. We go through that as a team for each individual stock, and then we look at that and how it's sort of moving over time. And it's a way of looking in the mirror and holding yourself to account. I think when you've got a long investment horizon, one of the things that you can be guilty of is thesis creep. And it's a tool that we've built to help prevent thesis creep and really forces us to look in the mirror at a regular interval and have that conversation across the team, look at directionally how these businesses are going across those categories and ask ourselves some tough questions, because you end up with a number for each position, and then you can look at the actual position sizing in your portfolio at the same point in time. And it's like, well, our scorecard saying portfolio scoring scorecard says we should be high or low position sizing in this or that. And, if you're not, it really drives some good conversation.
So then so that bench that you referred to before, is that also, like, those metrics also apply to the strong bench, so to speak? Like, who could we substitute on, so to speak?
Yeah, correct, exactly. So those names that are on the bench, like LVMH now, we'll still follow that more or less as if we owned it. So we'll track results. We'll have a model that we're kind of always updating and thinking about what our return expectations are from here. And it's always an open discussion of what's interesting and what are the best opportunities at any point in time. It's
a part of our process to put any new company that we're looking at that goes through the full investment thesis process is to run them through the portfolio scorecard, and you end up with a score at the end. And that is part of the conversation. Is this a better opportunity than other stocks that we own at the moment?
Does the whole investment team have exposure to like both sides of the universe, so like the Aussie and global, like the two teams intertwined, or how does that work?
Very much so. So we're not separated by industry or geography. As you said up front, it's around the strategic advantages that Nick spoke to, and you build up knowledge in. We've owned some of the we've previously owned Domain, for example, right? There's obviously some overlap between Domain and a Hemnet, for example. And a number of years ago, we owned Adevinta, which is another European-based classifieds business. You just build up knowledge in these ecosystems, and there's a lot of overlap when you're looking for businesses with network effects, strong and enduring IP, and extremely loyal customers. It doesn't know borders, if that makes sense.
Yeah, for sure. And that makes sense, because people that are looking at businesses with high, which are in this kind of rapid growth network effect type world, would kind of identify through pattern recognition just in their own lens over time. They'll flex that muscle again and again and again and say, well, this is probably going to fizzle out, or this one, we should look closer at this for these reasons. So one of the things that I said in the intro for people to listen on audio is recently we made a decision to include the ETF, the Global Fund ETF from Lakehouse in our portfolios. And I'll come back to that in a bit. But one of the considerations that I had was, firstly, how does this blend with existing positions, which is obviously what every investor should be thinking. But secondly, there was a period where there was, and I think I've got to mention this, there was a drawdown in both strategies, let's say. How do you guys think about protecting a portfolio versus like the concentration and backing your best ideas? Like, is that something that is, I guess, always front of mind? Like, are you thinking about that, or are you thinking our investors are here because you've got incredibly loyal investors like at Lakehouse? It's like, I remember when you told me how many of your investors come directly to you versus any other way. It's just remarkable. I have never seen a number that high. So obviously they're there, right? But how do you think about balancing the conviction to do what's right for them over the long term versus trying to insulate against volatility, so to speak, which is kind of, I don't know if I agree with that approach for what it's worth, but that's the question, I guess. Butchered question. Maybe Nick, start with you.
Yeah, I can jump onto it, and then Donny, feel free to add. I think on the volatility question, and nothing new in saying for us, volatility isn't really a risk parameter.
Yep.
We are fairly concentrated, and we are going to have very, very different results from the benchmark, right? So we will have some decent volatility in there. But I think in terms of the bigger question that you're getting at, really for us, where we landed was, that 20 odd names was the optimal balance. And I say that coming from a perspective of, yes, you want a healthy degree of diversification in there, but you also don't want to, well, you still want to maintain your ability to outperform, right? And that is to concentrate your capital on your best ideas and be able to actually get a differentiated outcome. On the diversification side, if you actually look at, and there's various studies out there, but once you kind of get to that 15 and 20 stock level, you more or less get about 90 to 93% of the diversification benefits. And then from then on, you're not really getting much benefit on the diversification side. And the reality is what you're trading off there is, and I don't know, obviously everyone's got their own style, their own way of doing things, but to be honest, I don't have 30, 40, 50 great ideas. And even if I did, I don't know actually how I would track them all in real time, to be honest. So I think having that, 2/3 of the fund are in our top 10 more or less, and we've got 20 odd companies. It might be a touch below that at the moment at about 18. Really allows us to know those companies well, track them in real time, and be able to make those active decisions when we need to, because obviously volatility is going to be ever present, and we want to try and use that to our advantage.
Just adding to that, Owen, I'd make the point around alignment. So everyone across the investing team are heavily invested in both of the funds. So when we're looking at markets and making our investment decisions, these are the vehicles in which we're compounding our own capital. So that brings a great degree of focus and effort and great meaning to what we're doing. I've got family and many friends that are invested in the funds, and I get held to account by those nearest and dearest to me. So there is a strong amount of alignment across the business, and that's how it should be when you're investing people's hard-earned capital. But just adding to what Nick said there, I think the alignment in times like that to give you the focus on making the right investment decisions is important.
For what it's worth, we spoke about this just before, we just happened to cross paths outside. But one of the things that I looked at is because most of our community, in fact, I'd probably say 90% plus, have more than one holding, so they're not just invested in Lakehouse. Some I'm sure maybe are, but they might have a property, they have cash, they have other strategies. And one thing for us is how the Lakehouse strategy blended with our existing portfolio really well, because if we are paying active managers like yourselves, we want you to back your best ideas, right? We don't want the watered down version. We want you to go out there and do what you would do with your money, because we believe in your process, your pedigree, and you can do it better than us. So that's why we pay, right? And I think about that a lot, like in my more consulting style days. If you ask everyone in the room, or the people that speak to a lot of different types of asset managers and portfolio managers, a lot of them come back to that. It's like, I have my best expression in every part of my portfolio, rather than trying to say you can be the not all that growth, but you can be the long-term growth, but also make sure I don't experience any volatility in the short term, please. Because then it just creates a misalignment of focus and incentives, right? So when I check your monthly updates and I see that X% is in the top 10, that gives me a lot of confidence that you are backing what you say you're backing. And I think that, for what it's worth, from someone that sends people's money out, I think that's really, really valuable. And I think financial advisors listening to this will get that as well, is that's what they're actively looking for. So that, I just thought I'd mention that, but we'll come back to the ETF in a minute. One of the things that I noticed on the investment strategy front here is, and I just wanted to circle back to this, Nick, for something you mentioned before. So if people go to the website, they'll see a bunch of different items. And one of the final things, I don't know if this is deliberate or not, but one of the final things on this list of dot points of the investment strategy was attractive valuations. I feel like if there's a lot of folks that are going to Omaha or have been to the Berkshire meetings, normally they think about valuation as one of the first things. So it seems to me that the process that you follow, Nick, is that's what kind of puts you on the bench versus in the portfolio. It doesn't get you even into selection, so to speak.
Yeah, the way I'd think about it is, you are right, that is intentional, that it's at the end of our process. And that's not to say it's not important, but if you kind of take a step back and think what we're trying to do at Global, it's, find the 20 odd highest quality, best businesses we can anywhere around the world. Now, it wouldn't shock you if I said a lot of the time, we do all our work, so our checklist, our full thesis write-up, all the discussions we have, get to an endpoint and say, geez, we'd love to own this business, and the but is normally the valuation, right? So I think we always want to do all the qualitative and all the work up front to figure out whether we want to own a business and then figure out if the valuation makes sense. Because if we're doing it the other way around and trying to kill ideas with valuation up front, then you're kind of never going to get anywhere in our view. And for any business, at least how we think about valuation, it's all grounded in our financial model. So we are probably on the more simple side in terms of our modeling. We try to keep it not as complex as it can get. We do believe that we want to be roughly right and not precisely wrong when we think about these things, but we do build out a 10-year operating model for every business we look at, and that's really, the main drivers there, obviously our revenue driver assumptions, what we think margins will be like at scale, and how we think about value in a terminal state, and then backing that out into an IRR. So based on our expectations, what return do we think we can get? And there's no hard and fast number there, but really what we're shooting for is 15% or better. If we can stack the portfolio with businesses that we think can, compound their earnings power at 15% per year or better, then we're very confident that the fund will follow that trajectory over a long enough time horizon, maybe not week to week, month to month, but over the long term of years. So that's really what we're shooting for. But obviously, if it's a business where we think the range of outcomes are a bit wider, for instance, or there's a bit more risk, even something like a MercadoLibre, right? Like our return expectations on that are much, much higher than 15%. We're getting into the high 20s in terms of what we think the business can generate. And that's because you do need to be compensated for the additional degrees of risk there versus something like if you told me we could earn 15% on Microsoft, I would say, load me up every day. But it's just, it's not kind of how it's priced.
Yes. Yeah, that makes a lot of sense. So one of the things that I'm cognizant of here is that if we talk about portfolio additions, subtractions, a lot of people think that then turns into a lot of shorter term myopic style trading in and out type holding periods. But Donny, I wanted to just pick your brain on this. Now, I don't know if this is one of those financial myths that are out there, but I saw a tweet a while ago and it was reportedly from, I think it was Morgan Stanley research. And it was something along the lines of the average fund manager, active manager holds a position for 7.4 months, right? And I don't know if this is 100% correct. I haven't done the research myself, right? But what would you say to that? If that was true, like would that surprise you?
That would not surprise me. There's a lot of noise out there. There's a lot of opinions and plenty of brokers the industry is structured to have a higher level of churn than we think is necessary if you're taking a genuine long-term approach. To give you some context, that implies getting towards 100% portfolio turnover a year, right? For us at Lakehouse, both portfolio turnover is 20%, sub 20%. So average holding period in the small companies fund is around 5 years. It's closer to 6 years in the global fund. Long term means different things to different people, but we believe we do what we say on the tin, and that's what long term means to us. So I guess for us, it's one of the genuine advantages that we believe that we have in markets is the 24-hour news cycle and brokers constantly throwing ideas in your mailbox. And if you want to play that game and go down that path, the industry is absolutely set up for that. But we don't believe it adds value. There's plenty of research that backs that up. The more you churn your portfolio, the more taxes, the more transaction costs that you incur. It's value destructive over time. And when I was on this podcast last time, you asked me what's one of the things that I'd change. And I think if we only had markets, if the ASX was only open one day a week, or whichever stock market only open one day a week, I think a lot of smart people could allocate their time to other more valuable endeavors. But that's our view of the world.
Yeah, I like it. And I'm glad you mentioned taxes too, and also the previous chat, because that was great. But taxes are one of those things that I think a lot of end investors aren't aware of. That if there is a lot of buying and selling, it increased costs, but it also can crystallize taxes, and you can have a great investment in a portfolio. Like Nick could pick a great stock for us, Donny, but if he's constantly trading in and out, we're incurring tax every time and brokerage and all that stuff behind the scenes. But the fact that you guys hold for such long periods of time mean that the end investor ultimately gets the purest form of that long-term return rather than this kind of, mishmash just in and out. Which may look the same on the surface, but actually underneath, it's a very different ultimate outcome once you pay the ATO its dues. So I noticed that because on one of the, maybe they're on both of the fund pages on the Lakehouse website, it's like at the top, which is a good sign because it comes back to that focus. And now I think that that's the hardest part of it all, to be honest, is staying the course and having that conviction through the cycle. Nick, I've only got a couple more questions, but one of them was, you see a lot of companies like every day, right? You're researching businesses, investors, capital allocators, all different types of people around the world. Is there anything that I guess you guys practice here at Lakehouse that maybe you think is quite unique, or something that you as a team believe perhaps that kind of lends itself to the values of long-term investing, quality and so forth?
I think a lot of the companies that we look at, given our time horizon, obviously culture is important and the people is important. So if you're looking to buy a business and sell it next year, maybe you're not too worried about, the integrity of the CEO or his capital allocation skills or whatever it might be. But for a lot of the businesses we're in, they're typically heavily reinvesting back in that business. And so, their skills, how they run the team, how the business is set up, is a thing we spend a lot of time thinking about. And I think that's probably one of the lessons we've had here in terms of thinking how we set things up internally. Obviously, we're a funds management business, so it's very people intensive. If we don't have people here, we don't have much. So for us, we do think about culture, how we want to set up the environment such that it's collaborative, everyone's involved and feels like, we're all going in the same direction. In terms of our culture internally, I would say we're pretty flat in terms of our structure. Donny does not have a corner office with a view of the park. He's not making decisions on any portfolio isolated by himself. If Vinny has a view on any given stock, or if, there's something that needs to be done, whether it's not even a glamorous job, Donny will roll up his sleeves and just do it. I think that's kind of the culture we try to create here, where everyone's just, in the same boat rowing together, and, there's no real hierarchy like that.
I like that rowing analogy. I think it works so well for corporate culture. For folks that haven't heard it, if you've got like 10 rowers on the boat, how many of the corporate are rowing forward, how many are rowing back, and how many are just sitting still? I think that's what culture really brings to like high performance businesses and teams.
100%. And one thing I would just note on that exact thing is, I think, incentives play a big part in that, right? We often get questions around, you're a bit of a smaller team, things like that. But for us, we think we've got the optimal number of hands to cover what we need to do. And ultimately, everyone is involved, right? We don't really aspire to have a team of 15 analysts and people sitting on the desk, and then all of a sudden the incentives for that 15th person you bring in is, I better get something in the portfolio, otherwise I might not have a job in 6 months, right? And things start to get a little bit perverse. Whereas, being a small, tight-knit team, if we win and outperform, we all win together. So, whether Owen is telling me something on a stock and it's making us avoid it, that is just as valuable as, if not more so, than owning it, right? Because it's saving us from losing, So I think trying to set that up so we're all on the same team and all shooting in that same direction.
We all have the same singular focus. It comes back to that point before, which is like, if you're trying to have your best ideas while also minimize short-term volatility, while also trying to do something else, you get all of those perverse incentives, as you say, not just through the team, but in other ways too. So Lakehouse today manages over $600 million and seems to be growing, and both funds at the time of recording outperforming significantly over the long poll. But what people might not know is that the business is also majority owned by staff. Maybe, Donny, for you, this question is why, like other than the obvious, why is that important to you?
Yeah, look, we've always been significant investors across the funds, and there's great alignment that comes with that. But in terms of the ownership around the business and being in the driver's seat with that ownership as majority shareholders, that's long-term lock-in. We've received very positive feedback from our investors, from the rating houses. It's what they want to see for a business like ours, and really provides that long-term focus. Nick and I are either side of 40, and we've got another good 20 plus years in us in terms of working. And with this ownership, that's our investment horizon. That's our thinking, is we're building a business for the next 20 plus years. So when we're going out and hiring our next analyst or hiring someone into our investor relations team, you've got that in mind, where you're trying to find the right people with the same philosophical and cultural fit to succeed over that long term and set it up so we all win together.
A different question then for you, because I like that, right? In every way, you're aligned on the business, but also in the strategies themselves. One of the reasons that we were able to allocate to Lakehouse is because of the listed vehicle, because of the ETF that you've made available. Feel free, either of you, to jump in on this one, but maybe Donny, why was that an important step?
Yeah, look, to be honest, the catalyst for that was we had some money that was in the global fund through the ASXM funds, and that was getting shut down. So that was the catalyst. But the ETF on the ASX was always in our future, because it just opens up the access to a much wider audience. So at the moment, when people come in direct, there's a fair bit of paperwork for AML, KYC, all of that sort of thing. This is just much easier. It's a lower hurdle. And, people like my children, if they're good little savers, they'll be able to put some money in as well at a much smaller amount than what the minimum buy-in was. So it really opens it up to a much wider audience, and we're pleased to have that. Yeah,
it's simpler. It's easier for people that might be listening and are happy to, take a bite today and then slowly get to know you guys, and that old land and expand model, which is very popular in funds management, right?
Yep.
That's how it all starts. Okay, so I've got, I'll put links in the show notes here. I've got a prompt for myself. I'll put links in the show notes to all of the resources, the latest letters. I'd say the Lakehouse letters since inception have been, since you guys incepted the business over 7 years ago, I think it is now.
Will be 9 in November.
Oh, right. Wow. So 9. Wow. That's okay. Time flies. Easily the most read manager letters I've had, as in you guys are the ones that I read. So I'll put a link in there, because people can learn a lot. Even if you're not invested, just read the letters. You'll become a better investor anyway. 2 final questions. Donny, you've been on the show before. This is a more of a personal question. What have you learned since, about investing? It could be about business. It could be about anything in that kind of field. What have you learned since starting Lakehouse?
Yeah, there's a lot of different ways we could go here, but I think one of the great observations that I've made, and we're 8.5 years old, is we're really starting to see the power of compounding come through for some of our investors now. So for both of the funds, our investors have 100% of their capital on top of the benchmark return. So we've delivered that in 7.5 years for global, 8.5 for smalls. Hopefully we can continue to do that into the future. And, if we do, it becomes 4 times, and you get how the compounding on that incremental return over and above the benchmark works. That's our point for existing. But where the rubber hits the road on that is what we see with some of our investors. And I'll give you 2 examples. One is, we were in Perth earlier this year meeting with a bunch of our investors over there, and one of the investors showed us a photo. He was living out his dreams, his best life. He'd been able to move out of Perth and buy a beach house sort of south of Perth, and he was really happy and proud about that, and said, Lakehouse allowed me to do this. In fact, he actually named it Lakehouse, even though it was beside the beach.
No way.
He showed us the photo of the little Lakehouse plaque name on the house, and that was nice. We've helped that person live out their best life, or some hopes and dreams that they had, because of that compounding that we've been able to deliver over this period of time. But I guess a more philanthropic example is another investor of ours has supported a number of families, that's housing and also education in Mexico. And they say the only reason that they're able to do that is because they've now got this extra money that we've, some extra wealth that we've helped create for them. And, it's hits the right place when you hear stories like that, what you're doing day to day, we've got this focus on trying to deliver strong returns for people, and what people want to do with that means different things. I've given you 2 examples there, but it feels like we're having an impact in our short existence, and for us, it feels like we're just getting started. There's another several decades ahead for us, and passing the baton on beyond that.
A lake house over in Perth. I like it.
By the beach.
By the beach, yeah. Beach house. So that's great. I didn't expect you to say anything like that. So that's really great, mate. Also, the fact that you mentioned 100% over the benchmark, which you're thinking like in cumulative percentage terms, right?
Yeah, if you look at the cumulative returns, so our initial ask on the small companies fund was 250,000, and on the global fund it was 100,000. Those have been lowered now, yes. But in terms of what investors have got, they've received the benchmark return on their capital plus that initial capital back.
Wow.
Over and above. So, we're short into the compounding journey, but it's nice to be having an impact for our investors so far.
It's pretty incredible. It comes back to what Nick was saying before about if you get the businesses inside the portfolio right and you hold them and they are compounding, there will be those kind of moments of volatility, but eventually markets follow profits, right? And they're compounding, and you're starting to see that kind of whip up for the people that were supporting you guys in the early days, and vice versa. It's that's awesome to see. So that's kudos to both of you. So Nick, final question for you is one that I always ask people on the show. And given this is your first time, hopefully the first of many, if you could go back and tell yourself one thing about finance, money, investing, life even, what would it be?
Look, to be honest, Owen, there's probably a few things I could tell my younger self. But, I think if there's one big thing for me as I've got older, what I've come to realize is everyone's always out there trying to improve themselves. But I think if you look at all the self-help, the gurus and everything, if you really boil all that down, it really comes down to choosing long-term over short-term. And I think, that goes across a lot of different things in life, whether it's, investing, your career, your health, your relationships. But, at the crux of it, it really is making decisions for the long term as opposed to just focusing on those short-term outcomes. And, if I could wind time back, I think if you can do that very early on, come to that mindset, with the power of time and how everything compounds, not just money, but knowledge, your career and everything, it can really make a huge difference in terms of where you end up 10, 20 and 30 years down the track. And I think that's probably the one thing I'd tell my younger self. I don't know whether he'd be smart enough to understand it, but
I think it's wonderful. And you're the first person, for what it's worth, that has said that and framed it that way. So choose the long term, or at least think of the long term over the short term. I'm just thinking of all the lessons that I could have, or mistakes I've made that could have been corrected had I been aware of that. Very simple but powerful lesson. Well, this has been great fun. So, Donny, thanks once again for joining me.
Good to be here.
And Nick, absolute pleasure to have you on the show. Like I said, hopefully first of many, but really appreciate you sharing some insights and being so generous with your time.
No problem. It was great.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.